The silent power of interbank trust. Nothing collapsed at first. No alarm sounded. Trust simply stopped moving. Modern banking runs on an assumption few people ever question: that banks trust each other enough to lend, clear, and settle every single day. Without that belief, money does not circulate, credit does not flow, and stability becomes an illusion. To understand why interbank trust matters so much today, we need to look at what replaced it. Because banks no longer rely on personal relationships or reputation alone. They rely on system collateral and expectations that trust will always be there when needed. For decades, interbank markets worked quietly. Banks with excess liquidity lent to those that needed it. Rates were predictable, transactions routine. This daily exchange kept the system balanced, efficient, and liquid. Trust was invisible, but it was everywhere. No bank examined every counterparty in detail. They trusted balance sheets, ratings, and the assumption that supervision had already done the work. Confidence was distributed, not debated. Then Europe integrated. Banks expanded across borders. Exposure multiplied. Counterparties became distant and complex. Interbank lending increased in scale. Even as familiarity decreased, trust was no longer built on knowledge. It was built on structure. At first, this seemed stronger. Collateralized lending replaced unsecured exposure. Clearing systems reduced counterparty risk. Models measured probability instead of relying on judgment. Trust became technical, embedded in rules rather than relationships. But something changed. Trust was no longer flexible. It became conditional. As long as systems functioned and prices behaved, confidence held. But when uncertainty appeared, trust did not weaken gradually. It snapped. Transactions slowed. Questions multiplied. Silence replaced routine exchange. Banks stopped asking how much to lend. They asked whether to lend at all. This is the hidden vulnerability of interbank trust. It does not fail loudly. It fades. One institution hesitates. Another delays. Soon, liquidity dries up without a single visible failure. Europe learned that trust cannot be engineered completely. You can support it. You can ensure it. But you cannot force it. And once it begins to disappear, the system feels the absence immediately. Because interbank trust is not a feature of banking. It is the foundation. And when it weakens, everything built on top of it starts to shift. When trust weakened, behavior changed first. Banks did not announce their fear. They adjusted quietly. Lending limits tightened. Collateral requirements increased. Transactions that once cleared automatically required confirmation. What looked like caution was actually self-preservation. The interbank market began to thin. Institutions preferred to hold liquidity rather than lend it. Cash became safety, not inefficiency. The logic was simple. If you're unsure who might fail next, it is better to wait than to risk exposure. This created a paradox. The system had enough liquidity, but it stopped circulating. Banks were not insolvent. They were uncertain. And uncertainty is contagious. One refusal led to another. One delay raised questions. Soon, even strong institutions were treated with suspicion. Trust no longer flowed freely. It moved selectively, cautiously, and sometimes not at all. Central banks watched closely. They saw funding rates diverge. They saw volumes shrink. They saw stress appear in places where balance sheets looked sound. These were not failures of capital. They were failures of confidence. Traditional tools struggled here. Lower interest rates could not force banks to lend to each other. Capital buffers could not restore belief. Regulation could not mandate trust. The problem was psychological as much as financial. So authorities intervened indirectly. They provided liquidity themselves. They became counterparties of last resort. By standing between banks, they reduced the need for direct trust. The system continued to function, but the market had changed. Interbank lending lost its central role. What had once been the backbone of daily liquidity became a secondary channel. Banks relied more on central facilities and less on each other. Trust was replaced by structure. This stabilized the system, but it also revealed dependence. When trust disappears, institutions turn to guarantees. When guarantees dominate, flexibility fades. The market becomes safer, but less dynamic. Europe had preserved stability, but at a cost. Because interbank trust, once lost, does not return easily. It rebuilds slowly through consistency, transparency, and time. And even then, it carries memory. The system remembers hesitation. It remembers silence. It remembers how quickly confidence vanished. And that memory shapes behavior long after crisis ends. Over time, the absence of trust reshaped the system itself. Banks adapted to a world where reliance on each other felt dangerous. They redesigned liquidity strategies around independence. Larger buffers replaced mutual confidence. Self-sufficiency became a virtue, even when it reduced efficiency. This shift changed incentives. Holding excess liquidity became rational. Interbank exposure became something to minimize, not manage. What once connected institutions now separated them. Safety came from insulation, not cooperation. Markets adjusted accordingly. Interbank volumes remained lower. Maturities shortened. Activity concentrated in the safest channels. Trust did not return to its old form. It reappeared in fragments, conditional and reversible. Central banks filled the gap permanently. Facilities meant for emergencies became structural. Liquidity provision was no longer exceptional. It became expected. Authorities were not just stabilizers of last resort, but anchors of daily confidence. This altered the balance of power. Banks depended less on each other and more on central institutions. The system became more predictable, but also more centralized. Risk shifted from private relationships to public frameworks. There was safety in that, and rigidity. Because when trust is replaced by guarantees, behavior changes. Institutions stop pricing risk through interaction. They price it through access. The system becomes stable, but less adaptive. Europe accepted this trade-off. After seeing how quickly trust vanished, preserving stability mattered more than restoring old dynamics. The goal was not to recreate the past, but to prevent its failure from repeating. Yet something subtle was lost. Interbank trust once absorbed shocks quietly. It allowed flexibility in moments models could not predict. Without it, the system relied entirely on predefined responses. And predefined responses work best in scenarios already imagined. The lesson was clear. Trust cannot be mandated, but its absence reshapes everything. European banking became safer by assuming trust would fail, and that assumption now sits quietly at the center of the system. What remained was a system shaped by memory. Europe's banks never returned to the world where trust flowed easily. Too much had been learned. Too much had been lost. Confidence, once broken, does not reset. It reforms under caution, not optimism. Interbank markets still exist, but they behave differently. Transactions are shorter. Collateral is heavier. Assumptions are fewer. Trust is no longer extended broadly. It is granted narrowly, reviewed constantly, and withdrawn quickly when doubt appears. This is not weakness. It is adaptation. The system learned that trust is not a permanent state. It is a fragile condition, dependent on transparency, stability, and belief in shared rules. When any of those fade, trust follows. Central institutions now stand where relationships once did. They provide continuity when confidence wavers. They absorb shock when hesitation spreads. Their presence allows the system to function, even when private trust retreats. But this comes with consequence. When trust is outsourced, responsibility concentrates. Flexibility declines. Stability improves, but spontaneity disappears. The system becomes more controlled, more deliberate, and less forgiving of error. Europe accepted this balance. After seeing how quickly silence replaced certainty, no one expected trust to behave the same again. The priority became endurance, not elegance. Survival, not speed. And so the quiet power of interbank trust was replaced by something more deliberate. Rules, buffers, institutions designed to assume doubt, because the lesson was unmistakable. Banking does not collapse when numbers fail. It collapses when belief does. And belief, once shaken, reshapes everything that follows. Subscribe to join the journey. The silence